Hi, this is my Netflix investment pitch. I'm a USC MBA student in corporate finance. I'm a CFA Charterholder as well, and my name is Databeta. Executive summary. The price has fallen 65% from the peak. Bill Ackman has taken $1 billion stake in Netflix because it has the best retention with the lowest monthly active churn rate at 2.5%, the best quality content with 44 Emmy Awards and 7 Oscars, the highest investment into content with $17 billion in content spent for 2021. They've increased the average revenue per user by 8% per year in the last 3 years. The largest subscriber base with 222 million subscribers. And they have an improving FCF and margin profile. We'll use a 10K to analyze that and show the expansion. The biggest concerns are slowing subscription numbers. The potential catalysts are to raise prices, to ban account sharing, and to limit content spend. What am I doing? I am buying. Netflix has fallen 65%. You see in this chart, in only 6 months, it's cratered to the bottom. Despite this, Netflix has gone up 22,000% since inception. So that kind of shows its long-term trajectory. At $215, Netflix is cheap, trading at 15 times earnings. You get that with a price of $215 at the top, and at the bottom, a $14 EPS, as shown here by Seeking Alpha, leading to 15 times earnings. That's attracted Bill Ackman for $1 billion or 10% of his portfolio. Since 2004, Ackman generated annual returns of 17% per year versus 10% for the S&P 500 total return. So he's doing a good job. So why did Ackman invest? He wrote this beautiful letter, which we will go through with actual charts instead of, just made up words in a piece of paper. Netflix has the largest number of subscribers with 222 million relative to its competitors. It is, double the size in terms of global subscribers. So really, Netflix is a juggernaut, as you can see here as well in the second chart. It's rising. It has the most content spending due to size and scale at $17.3 billion, almost double more than double Prime Video and Apple, its nearest competitors. It has the most awards with 44 Emmys and 7 Oscar wins, double this guy in second place, which is HBO, a pretty big heavyweight. And in terms of Oscars, it's also number 1. Netflix has the best retention rate among peers at 2.5%. That's the amount of people that cancel their subscription. And when compared to Apple, it seems that everyone cancels their subscription. Netflix and Disney are at the very bottom, with Netflix having the best retention rate. Now, they've raised prices by 8% per year. So even though they, even though they raise prices, they still have the lowest churn rate. So it's been pretty amazing. And they recently raised it again in 2022. Margins have expanded from 9% to 17% in 3 years, as you can see here in this common size income statement, going from 2019 to 2021. And that's because of declining costs of content spend and marketing. So in the last 10 years, it's actually expanded from 0%. So if we look at it from the long run, it's done even better. So just an amazing company. And this balance sheet kind of shows their whole business model. They spend cash to buy content. They've been financing it with less debt, and that's because they just have more profits. And they do this to expand their competitive moat. This has led to choppy cash flows, but keep in mind, management controls how much content they spend. So this FCF, it's something that they can control whenever, depending on what they feel. The biggest concern is slowing subscription growth despite high content spend. And you see right here that the paid net membership additions has fallen by 50%. So it's slowed down a lot, even though we still have an increase in membership, as well as an increase in the amount that they pay per user. So revenues have still grown in their largest revenue geographic segments, 13% growth in the US and Canada, 25% in Europe and Middle East. So Despite the concerns, revenue is still growing. Apple did the same raise the price strategy in 2016. It led to a drop in total iPhone sales, as shown here. This led to Apple falling 35% and trading at 10 times EPS, a solid buy that Warren Buffett took advantage of. And revenue still climbed though due to higher prices, so irrespective of the slower unit sales. Apple then proceeded to go up 450% in 7 years, making a good return for Buffett. So is Netflix a buy? Yes, according to the DCF. Here's a sample DCF. The base case and best case scenario, which assumes higher growth, can get you a 200% return at the bottom and a 500% return at the bottom. And worse and likely case, based on slower growth, you could get either 100% gain in the likely case or a 10% loss in the worst case. So I'll most likely make 100% or lose 10%, risk reward. So I bought $15,000 of Netflix. Thank you for watching my video.